Hello friends, good morning to all of you, and let's now discuss the basics of the BFM, and further we were covering the topic related to the risk management. So we have covered the one session, and I hope that you must have gone through that particular session. If you have not gone through that particular video, do subscribe the channel right now, and further just navigate to our YouTube page over there and you can follow that particular video. So please do confirm the audio video quality at the earliest, and do let me know that if you are able to watch this particular video without any particular issues. And further, we'll be starting the session over here. All right. As I've told you in the previous video that you can be getting all the free videos of JAIIB, CAIIB, and further the bank promotions if you join our YouTube channel, and further you join our particular a particular WhatsApp group over there. So please do confirm if the audio to quality is working all fine, and we'll be starting the session over here. Do confirm the same, and further we'll be starting the session over here. Okay, so the audio video quality is working now all fine. So let's start the session, and further we are going to cover the topic downside potential first of all. The downside potential first of all, it's particularly related to that we want to basically check the variabilities, right? Because we are interested in calculating the risk factor over there, so we will be going for the downside potential, because I told you in case of volatility, if you remember the last particular video, I told you in case of the volatility, we are having covered the both sides, right? If we basically look at the a random variable. So basically we are considering a random variable which is having the mean of RA, and further plotting the different values of the random variable for the different conditions. Then we basically found that we are covering both the sides, whether it's a positive side, whether it's a negative sides. Positive sides when the conditions are favorable, and negative sides when the conditions are not favorable. We are going to cover all the conditions, right? But we are not interested into the same. So in the case of downside potential, we just do cover the negative potential, we just do cover the loss side factors over there. And in case of the downside potential, I told you there are two major components. There are two major components. One of it's related to the potential losses that we need to calculate. That is quite difficult to calculate, but definitely we can do calculate the same. And the other factor, it's related to the probability of occurrence. Now it's quite difficult to calculate the probability of occurrence in that particular scenario over here. In this particular scenario, it's quite difficult to basically calculate that particular factor. Is that clear? Is that particular factor clear to you? Right now, we are having the technique which is particularly said to be what? Which is VAR. Which is VAR. Using VAR, we can easily be calculating the downside potential. Now, what is VAR? Let me just explain it to you with an example over here. I've already told you in the very last of the video. So VAR, that is value at risk. It is what? It is value at risk. It means it basically comes with the confidence limit. It basically comes with the confidence limit. Let's say case we are having the value at risk as 1 2 3 5 with 95% of the confidence limit, and for a time horizon of 10 days. What does it indicate? It indicates that for the 95% of the cases, under the normal working conditions, for 95% of the cases, if you trade for 10 days period over there, your maximum loss will be rupees 1235, and only 5% chances are there that your loss will exceed rupees 1235. That is VAR. That is VAR. And how we can calculate the VAR? We are just going to solve a question based upon it, and further you'll be learning all the things over there. Let's have a look at the question first of all. Do you want me to cover the case study based upon it right now? Kindly please do comment. Do you want me to cover the case study based upon it right now, or we should be covering it later on? Kindly please do confirm in the chat box at the earliest that should we be covering the case study based upon the same right now. Okay, so we'll be covering the case study right now, right? Okay, so let's have a look at the case study over here. So it's related to the VAR, that is value at risk over here. Value at risk over here, right? So it says based upon the previous 60 days trading data, the following information is available. So we are provided with the volatility per day that is given to be 2%. Okay, so it is given to be 2%, and they are considering assuming 252 days in the year. They are considering 252 days in the years. Number of observation days is particularly the 10 days. Now this particular days period is important because this is a time horizon. This is a time horizon for which we need to calculate the VAR, right? And the confidence limit is to be taken as 99% and investment amount is 60,000. We need to calculate the VAR for 30 days and 10 days. So I'll be calculating for 10 days for now, and it will be your homework so as to calculate the VAR for the 30 days, right? Okay, so let's have a look at it, right? First of all, we are provided with the volatility per day to be 2%. We are provided with the volatility per day to be 2%, right? Now, if we have to calculate the volatility, how we can be calculating the volatility? It will be investment amount is given to be 60,000 over there. So 60,000 multiplied by 2%. That is particularly the daily volatility. The daily volatility, we can easily be calculating the same using the same. So it will be equivalent to what? It will be equivalent to 1200. It will be equivalent to 1200 over here. Now, after that, we are to calculate the volatility for the particular time period of 10 days because we have to calculate the VAR for 10 days. So we will be now calculating the volatility for 10 days. I told you the formula yesterday. What would be the formula? It will be daily volatility. So it is a daily volatility over here multiplied by under root of time horizon. That is how we can be calculating the volatility for 10 days period. So daily volatility is 1200 multiplied by under root of the 10 over there. So volatility for the 10 days period, it will be equivalent to under root of 10 multiplied by 1200, and that is 3794. That is 3794. Is that clear? Okay. Now we are to calculate the value at risk, right? For 10 days period, we have to calculate the value at risk, and VAR would be equal to volatility for 10 days multiplied by the Z index value for the confidence limit. Z index value for the confidence limit. Now for the from the Z index table, we can easily be calculating the Z index value. For 99%, the Z value is 2.33. It is 2.33 for 99% of the value. How we basically came across this particular value? Now see, I told you the volatility graph over there, if you remember, right? That was the graph, and the structure was something like this, and this was particularly the mean value. This was the mean value. We denoted the mean value by RA over there, right? And I told you basically it is showcasing the probability that where the value will be lying. So you are having the 50% of the probability that the value will be lying on the right side, and 50% probability that the value will be lying on the left side over there. And the value of the probability for full value, the complete value over here, the complete value for both the sides, the value is 1. So the value of 0.5 is particularly on the one side and 0.5 on the other side, right? And further, if you're providing with the confidence limit of 99%, it is indicating basically 0.99. The whole value is particularly 0.99, including the tails over there, right? Let's consider up to these particular values. Let's say we are considering the 99% value for this particular case. In that scenario, we are going to consider this particular case. We want to consider this particular case over there, the complete value under this particular graph, right? We are interested in calculating these values, not the values beyond this. We are not basically interested into this. Is that clear? Is that particular part clear now? Okay, now we will be doing what? That 0.99 and further dividing it by 2. 0.99 divided by 2, and that is particularly 0.495. 0.495. Now we'll be looking for the value of 0.495 in the Z index table, and it would be equal to 2.33 over there, right? Let me just showcase the Z table to you. The table will not be given to you in the exam times. There are a few values that you need to memorize, so just consider memorizing such values, right? So in this particular scenario, we are providing the whole values over here. So you need not to do what? Basically, we are considering for 99% case over there. So you need not to consider the case related dividing it by 2 over there. Simply just look for the 0.98. It basically comes with two type of the Z index tables over there. One it is related where you need to divide it by 2, where the half structure is given, and further we need to cover the value in that scenario, right? Now you just be looking for 0.99 value. We will just be looking for the 0.99 value, right? Is that clear? So just look at the graph over here. I'm just zooming it in. So we are having the value of 0.99 somewhat over here. It is 0.9898, and further after that it is 0.9901. Now this value is particularly corresponding to look at here 2.3 on this side, and for the decimal part it's on this side, so it is 2.33. So the value is 2.33. Is that clear? Right. So simply we will be doing what? We are having the value like for volatility for the 10 days. We are having the value like 3794 and multiplied by 2.33. That will be equivalent to 2.33 multiplied by 3794, and that is 8840. 8840. Is that clear? This is our answer is, that is 8840 is our answer. Now what does it indicate? It indicates that if we are trading over the time horizon of 10 days with 99% of the confidence limits, that is our maximum loss under the normal conditions will be limited to rupees 8840, and only 1% chance is there that your losses under the normal conditions will exceed 8840. That is the value at risk calculation. I hope that you must have understood the concept related to value at risk. Kindly please do confirm at the earliest if you have understood the concept related to value at risk. And further, if you have liked the video so far, kindly please do give this a thumbs up, and further do share it with your friends and colleagues. It's a humble request to you all guys. Kindly put this video link as your WhatsApp status, and you can also be sharing in the Facebook pages and groups over there, so that people who are interested in covering the CAIB, they shall be able to cover the same free of cost on the YouTube, right? Okay, now let's move further toward the other part, and it's actually related to, we have covered the risk measurement. So we were basically in the process of first of all we have identified the risk. Now the second one, it was related to risk identification, risk measurement, that is risk quantification. So first one, it was related to identification. The second one, it was related to quantification. Under quantification we covered risk sensitivity, we covered volatility and also the downside potential, and covered the case study based upon the VAR, right? So that was the case. Now after that, it's related to the risk pricing. Now pricing means what? That how you are going to price the particular loan over there. Like you should be considering the tenor of the loan, you should be considering the overhead costs over there, you should be considering the amount that you're paying to the depositors over there, and also you should be considering the risk premium, right? So these things are to be considered, because there is always a possibility of loss. There is probability of loss that is lying with the loan account over there, and that should be factored into the pricing over there. So that should be considered, right? So the following are the factors which should be taken into account. First of all, it's related to the cost of the deployable funds, because you are not having the funds of your own, you are basically having the funds from the public, and you are paying them the interest over there. And also whatsoever the operating expenses like documentation expenses, you are paying the particular employees salaries, you are paying for the rent, electricity, etc. And also there is a possibility of loss, that's a third factor over there. And then it's related to capital charge. Now what is a capital charge? It's quite important point over there. Now, what happened actually under the Basel 3, under the Basel 3, and also under the Basel 1 over there, it was particularly being said that you are to maintain the risk-weighted assets capital, risk-weighted assets capital. That's a capital adequacy ratio. We also say the CAR, or we can also be naming it as CRAR. It is a capital risk-weighted asset ratio. Now, for these particular cases, we are to maintain the capital adequacy ratio and what also for the CRAR, that is a capital risk weight asset ratio. Now, what does it indicate? Let's say the case that the bank has sanctioned 100 crore of the credit card loan. Okay, the bank has sanctioned 100 crore of the credit card loan. Now, the bank is particularly taking a risk. But in the case of credit card, the risk is much more as compared to the risk taken in the case of housing loan or some other category of the loan, which is quite some secured, right? So that's the case. Now, for that scenario, the RBI said, as per the Basel guidelines, that you are to maintain 125% of the risk weight assets, because the risk associated with the credit card loan is much more than 100 crores over there. So RBI give the percentage to be 125%. So we will be considering it not as 100 crores over there, but we will be considering it as 125 crores of the risk weight assets over there. This is a risk weight asset percentage, right? This is different for the different type of loans over there. We'll be covering it further in the next unit over there, right? So it will be 125 crore over there. And as per the Basel guidelines, RBI said that you have to maintain minimum 9% of the capital. 9% of the capital. So 9% of the capital would be equal to whatsoever the amount it will come. So that is a capital charge. Now on that particular capital that you are to maintain, because you're taking a risk, that is basically to safeguard the bank from bankruptcy, so as to safeguard the depositors' interest over there, because the bank is taking a risk over here, right? So that is to be maintained, and the bank will be getting nothing over the same. So that is to be considered, right? While you're basically pricing a loan, so that factor should be considered, and that is the risk pricing. So in risk pricing, we are having the four factors. One, it's related to the deployable funds. Second one, the operating costs. For third one, the loss probability or possibility, and the fourth one, it's related to the capital charge over there, right? So we have already covered the risk identification process. If you basically remember, we have got the risk identification process, and the second one, it was related to the risk quantification or measurement process, and third one, it was related to the risk pricing. We have covered that particular point. Also, the fourth point in risk management, it's actually related to monitoring and control, right? It's monitoring and control, and it's just right here. Now, under the monitoring and control, the bank should be having a particular organizational structure over there. Bank should be having an integrated, comprehensive approach so as to manage the risk over there. The bank should be having the deployable standards and policies which must be there, and all the particular limits and triggers should be there, so that the bank can particularly be controlling the risk also, and also monitor the risk. Monitor is particularly related to that you have framed the guidelines, and for them you are monitoring whether those guidelines are being followed in letter and spirit. And when I'm talking about the controlling, it's just related to curbing the particular amount of risk up to some particular amount of level over there. That's the risk control point over there, right? That's the main thing related to it, right? So basically, monitoring says what? Monitoring is there so as to ensure that the divergence between the planned performance, because I planned something that I want in that particular manner. Now particularly I will be looking into the whatsoever I have planned and whatsoever the actual performance is, and further I'll be looking into the difference of the same, and that is particularly what we want, right? So that's the case. So that was actually related to monitoring and control, and after that it's related to the risk mitigation. That's the last step related to the same. Now, as I've told you, risk is there due to the uncertainty. Risk is actually there due to the uncertainty associated with the same, right? And further, we want to reduce the risk. We want to reduce the risk over there. So there are different techniques that how we can be mitigating the risk, how we can basically be avoiding the risk over there. Like let's say case, we can be going for the credit derivatives. We can be going for the credit derivatives if we want to safeguard ourselves from the credit risk over there. Like we'll be purchasing the CDS, that is a credit default swap, or we'll be having the credit linked nodes over there, or we can be going for the TRS over there. We'll be learning about all the things later on, right? So you should be watching this particular video. And further, during this particular video, we have learned so many concepts which we cannot be learning using the questions video over there, but in the theoretical video we can be learning such many concepts over there. And also, if you want me to start the Google Meet, if you want me to start the particular Google Meet over there, so that you people can be interacting with me, do let me know. We can be having such a session, we can having such a interactive session also, right? So let's start particularly with it. So for mitigation, we are having the different things, like I told you already, that we can be buying the credit derivatives. We can be basically be looking for the mitigate the interest rate risk, that we can be using the interest rate swaps over there, or we can be having the other measures also by using which we can be mitigate that particular risk over there. And also we can be mitigating the risk using the diversification technique, because I told in the previous lecture also that the risk might be on the transactional level and the risk might be on the portfolio level. When I talk about the risk on the portfolio level, what does it indicate? It indicates that particularly the risk is at overall all the levels over there. Let me just indicate that particular data to you. Let's say case we are talking about the concentration risk. Let's just take the case we are talking about the concentration risk. You are having a portfolio over here, and further you have just sanctioned the loans related to the housing loan, right? Now if the housing sector is low, in that case you'll be having a huge risk. But what if we have sanctioned the loans for the different categories? We have sanctioned the loans to the MSME category, we have sanctioned the loans to the retail sector over there, we have sanctioned the loans to the agriculture sector over there. Now, in that scenario, even if the one of the sector or two of the sectors goes down, still you'll be having the profitability on the other portfolio side over there. So you have to basically take care of the same. You have to take care of the same over there. So that's the main funda. And other than that, what the case is? Other than that, if we talk about the mitigation, if we talk about the mitigation over there, we have basically talked about the different types of risk over there. We have talked about the interest rate risk, we have talked about the credit risk. So for the different types of the risk, you have to look for the different strategies that how you can be managing. So one technique that we basically learned about, that's actually related to risk mitigation through the diversification and the portfolio. Like particularly, let's say if you're having the different business lines, let's say we are having the different business lines. We are having the lending business line, we are having the investment business line. Now for, let's say, for both of these scenarios, both of these business lines, for lending we are having the standard deviation to mean as 4, and further for investment we are having the standard deviation to mean as 5 over there, right? Now if we look collectively it will be somewhat around 4.5, right, if we calculate the average of the same. So that is particularly through the diversification. So when you're having, let's say your risk was previously 10, now you basically adding the loans which where the risk is lower. Let's say the risk factor is only about 7, right? Now the fact this particular will be having an average impact on the portfolio also. So if you were previously taking a risk of quantum 10, but now you're taking a risk of quantum 7, the new loans which are being sanctioned by the bank are having the lesser risk, then overall portfolio risk will also be lesser now, right? So that's the case. So this is also how this can work, and further this is related to you can be diversifying your risk factor over there. Is that clear? Is that particular part clear over there? Okay. Now that was actually all about the particular this unit, and we have covered the case studies also so far. So give this video a thumbs up if you have liked the video so far. Now we'll be covering the next unit, and it's related to the risk and banking business over there. Risk and the banking business over there. Now if we talk about the banking business lines, if we talk about the banking business lines, we are having the three business lines. The bank is having the three business lines. One, it is related to the banking book. One, it's related to the banking book over there. Now what is actually the banking book? So whatsoever the advances, whatsoever the loans are being sanctioned, whatsoever the deposits are there with the bank over there, so whether it's related to the loans, so or it's related to the deposits, or it's related to the any kind of borrowings, those all are covered under the banking book. Those all are covered under the banking book, right? And whatsoever the assets and liabilities are there in case of the banking book, those are held till maturity. So it is particularly being considered that whatsoever the loans are there, whatsoever the deposits are there, or whatsoever the borrowings are there, those will be kept at HTM basis, that is the held till maturity basis. It means what? That the market risk won't be there because you're not going to sell them beforehand, right? So market risk is actually not there. But definitely there can be a difference of the interest rates, like the interest rate for the different assets and maturities can be different, so there will be interest rate risk. So the interest rate risk can be there. And also it may be the case that your maturity for assets and liabilities may be different. Let's say case that you are having the deposit for the 3 years, but you have sanctioned the loan for the 5 years. That can be the case that we basically took as an example in the first unit over there, first particular video over there, right? So that can also be the case over there. So in that scenario, what risk will be there? Kindly to let me know. If you're having deposit for 3 years, but you are having the loan sanction for 5 years, will there be liquidity risk? Yes or no? Will there be liquidity risk? I'm talking that the bank has sanctioned the loan for 5 years, and further, the bank is having the deposit for 3 years. So, liquidity risk can be there. Kindly to confirm. Kindly to post a message at the earliest. Can the liquidity risk can be there? Of course, the liquidity risk can be there. The liquidity risk can be there in this scenario, right? So it will lead to what? The liquidity risk is also there. So I just want to convey that in case of banking book, we are having the different types of risk, but we are not having the market risk because holding the assets till maturity, because we are holding the assets till maturity. So the particular market risk is not there, but we are having the liquidity risk in it. We are having the interest rate risk in that. We are also having the default risk because the counterparties can default, and also there can be other form of risk, like can be having the operational risk. And the most important point, other point related to this is that it follows the accrual basis of accounting. Okay, so the accrual system is actually followed in case of banking book over there. Okay, now that was the first banking line, that was the first business line, and the other one it's related to the trading book. So one book we are having the banking book, and the other book we are having the business line is particularly the trading book over there. Now what is a trading book? So when you're having the shares in your portfolio, you are having the capital instruments in your portfolio, right? That's particularly what? That's your trading book. Because we are considering, under the trading book, we are considering those assets which are marketable. Okay, so we are considering the assets, but we are considering those particular assets which are marketable over there, right? Which you can be selling in the market before their maturity. So it's basically in this particular system, we are going to keep the assets on MTM basis. MTM means what? It is marked to market basis. It's marked to market basis. Okay, so under the trading book we are having the MTM particular things, that we basically want to keep those particular marketable assets which we can be selling before the maturity. So we'll be making a little profit, and further we'll be liquidating that particular profit over there, right? So that's the case over there. So definitely the price will impact, so the price risk will be there in this scenario. In the previous scenario, in the case of the banking book, the price risk was not there, that's a market risk was not there. Price risk or market risk, all the same thing, right? So the market risk is definitely there in that scenario. The interest rate risk is there in that scenario, and the liquidity risk is there in that scenario, right? So those all things are there. Adverse movement of the prices can basically be impacting it, and further we can be having the liquidation risk over there. We can be having the counterparty risk or operational risk over there. So that's actually related to the trading book over there. That's actually related to the trading book, right? And further, after that, the third one, the third business line is what? The third business line is off balance sheet exposure, or simply we say it OBSC. That is the off balance sheet exposure. Now, off balance sheet exposure is particularly all those cases which are contingent in nature. Today it is not going to impact you because it is not crystallized, but it may crystallize in the future. Whatsoever the obligation is there, where there is no direct outlay of the fund, but there can be outlay of the fund later on stage. That's the off balance sheet exposure. That's the off balance sheet exposure. So whether you are basically considering the letter of credit or a bank guarantee, those all are covered under the off balance sheet exposures, right? And derivatives are what? Derivatives are also off balance sheet exposure. Let's say we are talking about the swaps or futures, those are the off balance sheet exposures. And further, they are contingent in nature, that there can be for outlay of the fund in the future. Right now there is no direct outlay of the fund, that's the contingency. That is a contingency. And further, these off balance sheet exposures can become the part of the banking book. They can become the part of the banking book, and also they can become the part of the trading book. So they can become the part of the banking book, as well as they can become the part of the trading book over there. So they include all types of risks, whether we cover, let's say, interest rate risk, market risk, liquidity risk, operational risk. Because let's say if we are considering a component of OBSC to be banking book, it will be having the interest rate risk, liquidity risk, etc. And further, if we are considering it to the component of the trading book, then definitely it will be having the risk related to the particular market risk, etc. So those all risks will be there. So all such things are being covered in that scenario. Is that clear? Is that particular part clear over there? Now, we'll be considering the different types of risk over there. Now, let's consider the different type of risks which are being imposed. First of all, we are going to cover the liquidity risk. We are going to cover the liquidity risk. Okay. And under the liquidity risk, we are having the different types of particular types of liquidity risk. Like we are having the funding risk, we are having the time risk. I've already conveyed some of the definitions to you, but definitely I'm going to cover them again so that you can be having an idea. And the third one, it's related to the call risk. So we have the three categories under the liquidity risk, first of all. Okay, now what is funding risk? Now, what is funding risk? Now, let's say case there was non-renewal of the deposits, or there was unanticipated withdrawal, and further, you were basically considering that you are having the deposits for 5 years period. Let's say, okay, and further you have sanctioned a loan for let's say you are having the deposits for 3 years. That is 1, 2, and 3. So it is 0, 1, 2, and 3. That is your deposit. That is a deposit that you are having. And further, you have sanctioned the loan for the 5 years, for the 5 long years. You have sanctioned the loan, right? Now, after the 3 year period, now after the 3 year period, the deposit was not basically renewed. It was not renewed, and the person withdraw the amount. Now you have to basically replace particular these net flows. You have to basically replace the net outflows, okay, due to the particular non-renewal of the deposits over there. Now you're having the liquidity risk, but what kind of liquidity risk? It is a funding risk over there, that how you are going to fund this particular loan account for the next 2 years, right? So that's the funding risk. I hope that you must have understood. Kindly please do let me know that if I have understood the funding risk category over there. The other one, it's related to the time risk. Let's take the case that the annual installments were there. Okay, you were to receive the annual installments, but there was a default in receiving the amounts. That was, there is default in the repayment of the account. So if there is default in repayment of the account, in that scenario I was basically considering that I will be getting the amount paid back, but I'm not being paid back the amounts over there. So that is what type of risk? That is also the liquidity risk, because I was assuming that I will receive back the amounts, but I'm not able to receive back the amounts. I may have to deploy the amounts somewhere, but now I'm not receiving the amounts. So that will also be creating a risk. So that is what? That is a time risk. Now you will be saying this is a credit risk over there. Now see, the credit risk is also there. Credit risk is also there associated with the default. Associated with the default because the counterparty defaulted. But on the same hand, It may be the case that the whatsoever the amount that was being received by me as the repayment, I was to deploy that particular amount, but now I'm not receiving that particular amount, and further I have to get that particular amount from some other source, which I may not be able to get at the same rate of interest, right? So that is particularly will be leading to the time risk over there. That will lead to the time risk over there. And when your contingent liabilities do crystallize, in that scenario, it will be the call risk. Okay, so the call risk crystallizes, or call risk is particularly there due to the crystallization of the contingent liabilities. Okay, so when the contingent liabilities, basically, let's say has given a bank guarantee, and further that crystallized. Now in that scenario, it will be what? It will be the call risk, because you have to arrange the funds now. Previously, you were not to basically arrange the funds, but now you have to arrange the funds over there, right? So that is the case. I hope that you must have understood the scenario. I hope that you must have understood the scenario. Now, should we be moving to the other category of the risks over there? Should we be moving to the other category of the risks over there? Now, the second category that we are going to cover over here, that's actually related to the interest rate risk. And we are having the different categories under the interest rate risk category also. Now, let's have a look at those also, right? So the interest rate risk, we are having the different types of the interest rate risk. First of all, it's related to gap risk or mismatch risk. The second category, it's related to the basis risk. The third one, it's related to the yield curve risk. Yield curve risk. And the fourth category, it's related to the embedded option risk. Embedded option risk. So we are having these categories, and also the last one, it's related to the reinvestment risk. Okay, so these are the different risks which we are having under the interest rate risk category. Now, when the interest rates do move, your revenue may be having an adverse impact. Okay, it may be the case, because if the interest rate moves, it may be the case that it's in a bad position, and for the your earnings may decline in that scenario. That is the interest rate risk over there. That is interest rate risk. Now, what is the definition of the gap risk? First of all, what is the definition of gap risk? Let's say case that you are holding the assets, you are holding the liabilities, but and you're also holding the off balance sheet exposures. So whether we are holding the assets or liabilities or the contingent liabilities, all the three things, but there is mismatch in the maturities. There is mismatch in the maturities. There is mismatch in the principal amount. Like, let's say you are having the assets for 3 crore, but you're having the liabilities for 2 crore. Okay, that's a particular what? That's a positive gap. So if your assets are more than the liabilities, in that scenario, that's a positive gap. That you're having more assets, because we are having more inflows and lesser outflows. That's a positive gap. But it may also be the case that you're having the negative gap, that assets are lesser than the liabilities over there, that your whatever the amount you have to pay, that is more, right? So there can be the negative gap also, there can be the positive gap also. There can be the positive gap also. Now in the case of the negative gap, definitely if the interest rate will alter, it will be impacting you much more differently, right? So that is the case, that will be particularly giving you a hit, right? So that's a gap risk over there. So it may be due to the difference between the repricing dates, that your assets are being repriced on some other day, your liabilities are being repriced on some other day. It may be the case that your assets and liabilities or contingent liabilities are having the different maturities or different principal amount. If the interest rate changes on them, that will impact you hardly, right? So that's a gap risk. That's the gap risk over there. The second one, it's related to the basis risk. Let's say case that on deposits we are paying a fixed interest rate of 7%, but on our loans we are receiving an interest rate based upon the repo rate, plus some, let's say 2%, repo rate plus 2%. Now in that scenario, if the repo rate reduces, your net interest income will also reduce. Your net interest income will also reduce, and your overall income will be reduced. So that is what, that is a basis risk. That is a basis risk. And after that, it's related to the yield curve risk. It's related to the yield curve risk. Now, what is yield curve risk? What is yield curve risk? Now consider the graph over here. Just consider this particular graph. Let's say case, in case of the treasury bills with the 91 days of the maturity, this is a yield curve. And further, for 182 days of the maturity, the yield curve is something like this. And for 364 days here, the yield curve is something like this. Just consider this particular factor. Just consider this particular factor over here. Okay. Now, you're having the instruments, you're having the instrument over here, you're having the different instruments over there which are maturing over the different time horizons. One matured in 91 days, the other one matured in 182 days, and the third one is maturing in 364 days over there. Okay, and further, it is related to the same instrument but maturing over the different time horizons over there. But over the different time horizons over there, on 91 days treasury bills, you are having the different yield. On 182 days, you are having the different yield. For 364 days, you are having the different yield over there. And there is non-parallel movement of these yield curves over there. Non-parallel movement of the yield curves over there, and definitely it is going to impact your net interest income, right? Net interest income, because you are having the different particular products, assets and liabilities based upon the different different particular time horizons, but of the same category, then also it will be giving a rise to the risk factor. That will be said to be what? That will be said to be the yield curve risk, because the yield for the same instrument under the different time horizons is going to be different, right? So that's quite basically, it's understandable. And after that, it's related to the embedded option risk. Embedded option risk. Now, if you're having an FDR, the depositor of the FDR is having an option that he can get the premature withdrawal of that particular FDR. If you're having a loan, if you have sanctioned a loan, there is an option that the borrower may prepay the loan amount. So that's particular word. That's a embedded option risk in that scenario. Is that clear? Is this particular part clear to you now? Okay. And after that, it's related to the reinvestment risk. It's the reinvestment risk. Now, reinvestment risk says what? The reinvestment risk says what? It may be the case there is uncertainty whatsoever the inflows that you are receiving, that you may not be able to particularly deploy the funds at the same benefits. Let's say case, previously you were having, let's say, deployed the funds, that you have sanctioned the loan, and you were receiving 11% per annum rate of interest. That was your income that was being generated from here, right? But now whatsoever the amount that we are receiving as repayments, let's say there is no default in the account and you are receiving the EMIs over there, but now you're not able to deploy those EMIs at 11%. It may be the case that you may be able to deploy the EMIs at a lower rate now, right? So that will be what? That will be the reinvestment risk. So that is particularly said to be the reinvestment risk. I hope that you must have cleared with the same. Okay. So these were the types of the interest rate risk over there. It is the gap risk, it is a basis risk, it is a yield curve risk, embedded option risk, and also the reinvestment risk. I hope that this particular point is clear to you. Kindly please do clear the same. Kindly please, you can post a message yes, or you can also be posting a smiley icon, or a particular yes will work, that you have understood the concept so far. Kindly please do let me know the same. Okay. Now, after that, after the interest rate risk and liquidity risk that we have understood, the third category that we are going to cover, it's the market risk. It's a market risk category. Now, we are going to cover the type of the market risks over there. Now, what is market risk actually? What is the market risk? Market is basically related to what? due to the adverse movement or adverse deviations of the MTM value. MTM is what? MTM is marked to market value. Because let's say if you're having the tradable securities in your portfolio, if you're having the tradable securities in your portfolio, it may be the case that the particular value on daily basis is not appropriately moving, not in your favor. That will be what? That will be the MTM value, that is a mark to market value, right? So if there is adverse movement of the prices, adverse movement of the prices, that will lead to what? That will be leading to market risk over there. That will be leading to the market risk over there. And we have the different type of market risk over there, right? Now, price risk will basically be there when the assets are being sold before their maturity. When the assets are being sold before the maturity. Now, it can be the forex risk. It can be the forex risk, or it, let's say we also name it exchange risk. Exchange risk over there. And also it could be the market liquidation risk or market liquidity risk. Market liquidity risk. Now, market liquidity risk is very much different from the liquidity risk at all. So we'll be understanding the point. We will be understanding this particular point. Okay. Okay, so first of all, it's related to the forex risk or the exchange risk because there is movement, there is very dynamic movement in the forex prices over there. So that's quite obvious. That's a forex risk. And for the, let's say today the price of the USD, this moment the price is 84 rupees. It may be the case that after just 2 minutes the price is 84.30, right? Now it may be basically be impacting me. I'll maybe having much more losses, right? So that's a forex risk. That's a forex risk. And also I may be having the market liquidity risk. Now, what is market liquidity risk? Let's guess when I'm not able to conclude a large transaction. I'm not able to conclude the large transactions nearly the current market value over there. I'm having, let's say, 10,000 shares, 10,000 shares of particular company, right? The share price in the market is rupees 90, but when I'm going to sell 10,000 shares in a lot, I'm not able to get rupees 90 as the price over there. I'm able to basically conclude the transaction, let's say, at rupees 87, right? No, that's not just because of the price adversity, but that's because I'm not able to conclude this particular transaction over there. That is what? That is a market liquidity risk. That's a market liquidity risk over there. Is that clear? Is that clear? Is this particular part clear over there? Other than that, we may also be having the credit risk. We may also be having the credit risk, or we say it to be the default risk over there. Under the credit risk, also we are having the two types. Let me just write it over here. For the credit risk, we may having the two types. One, it's related to the counterparty risk, where the counterparty defaults, the other party did default, is not basically able to uh, basically conclude their obligation. So whatsoever the obligation on there, the counterparty is not able to basically perform that particular obligation over there. That's a counterparty risk over there. And also it may be the contrary risk. It may be the contrary risk. The counterparty wants to perform, but due to the restrictions imposed by the country, the counterparty is not able to conclude the transaction. That is a credit risk also. That is a credit risk also. Okay, so these are the types of the credit risk. So we have so far covered the different types related to the interest rate risk, liquidity risk, market risk, and the credit risk. And further, we may also be having the operational risk. In the operational risk also, we are having the different types. Now let's consider, we may be having the operational risk. Now operational risk is basically related to what? Due to the inadequate or failed internal processes, whatsoever the risk is imposed, it may be internal, it may be external also, right? So that is what? That is the operational risk. Let's say if there is natural calamity, okay, so that's operational risk. Let's say there was a fraud by the employees, that's an operational risk, right? And this could be related to the transactional risk. It could be related to transaction risk, or it could be related to the compliance risk. Compliance risk. right? These are different types over there. Now, when we're talking about the particular transaction risk, what type of transaction risk can be there? It could be related to some fraud, which may be internal or external, and also it could be related to failed business processes, that business processes did fail over there, right? So that's the case. And also it's related to compliance risk. The other one, it's related to the compliance risk with us. Now, what is compliance risk? Let's say there was some regulatory thing that you have to maintain, the, let's say, CRR or SLR, or let's say capital adequacy ratio was to be maintained, but you're not able to comply with the same. You're not able to comply with the rules, regulations, laws, code of conduct, or standards for good practices. You're not able to comply with the same. That will impose a risk on your reputation too, right? That will basically, it may be the case, a penalty may be charged on you, right? So that is what type of risk? That is a compliance risk. Okay, so that is also there over there. Other than that, we may be having the strategy risk when you are having inappropriate strategy that may be basically impacting your overall profitability. And also we may be having the reputation risk. Also, we may be having the reputation risk imposed on us. Is that clear? Is that particular part clear over there? Now, do let me know at the earliest that do you want to join the Google Meet with us? If you want to join the Google Meet with us, do let me know at the list. I'll be sharing the link with you guys. I will be just sharing the link with you guys related to this particular uh, video, so that you can be joining us. So that you can be joining us on the Google Meet, right? So I'm just going to share the link with you guys, and you can be joining. I've just shared the link in the chat box now. So do join the Google Meet at the earliest, so that we can be having an interactive session over here. Okay. So if you're having any queries related to today's session, you can do post the queries at the earliest. I have already shared the particular link with you guys, and I've already conveyed the idea that full course is available, and now you'll be getting all the free sessions. And for CIB free case studies, you just simply need to WhatsApp CAIB guide, and you need to WhatsApp it to the number 83609 Just do WhatsApp it at the earliest, and further we will be adding you to the WhatsApp group, and further you'll be able to access all the particular PDF files over there. So kindly do the needful, and further you can also be joining the interactive session right now. If you want to join me live, you can be joining us on the Google Meet right now if you're having any doubts or any queries related to the same. I'll be just waiting for another 1 minute for any query or other things from your side, and else we can end up this particular session. And further, this session will be removed as soon as possible, just after 24 hours. And further, all the sessions won't be available on the YouTube itself, but those will be available free of cost to you when we'll be live streaming. So during the live streaming, those all the sessions will be available to you. So we'll be meeting you again tomorrow in the morning at 6:45 a.m., where we'll be covering the most important concepts related to the CAIB BFM over there. And we are going to start the bilingual sessions as well as very soon, right? Very soon we are going to start with the same. So you can be joining our WhatsApp group right now. Just simply WhatsApp CIB guide and WhatsApp it to the number 83609 where we do share whatsoever the content we are going to cover in the tomorrow session, and for the different questions related to the same are also covered, right? So do join that particular group. That will be quite helpful for you guys. So that will be all for this particular session, and further, let's meet in the next session tomorrow in the morning at 6:45 a.m. At 6:45 a.m., we will be meeting tomorrow for the tomorrow session. Thank you so much, and see you again in the next session tomorrow.